at it year on year, and largely in line with estimates. Also, with regard to operating profit, very similar, above estimates or slightly above estimates, just about 23,885 is where that number has come in at, 27% growth year on year. It's a degrowth when I'm looking at it sequentially, largely because of a sharp degrowth in the other income number. That's what's really pulled down operating profit on a sequential basis. But of course, certain one-offs in that other income number for Q4 FY24, so not the best metric to look at. In terms of provisions, well within what the estimates indicated. 3,000 crore is what our number was looking like. It's come in at 2,600 crore, so a positive there. And the profit after tax has come in at 16,174 crore. While that's a 2% degrowth on a sequential basis, overall, you're looking at the number which is largely in line with estimates. The growth numbers have come through, but what's really important here is the EPS growth number. This is something that most analysts have been tracking closely. It's a 1.5% degrowth on the EPS front on a sequential basis, a 0.5% increase on a year-on-year basis. So nothing significant in terms of growth. Your margins have come in largely stable. This was a number which everyone was looking at with deep detail. 3.47% is now where the margin number stands versus the 3.44% in Q4 FY24. You're also looking at a degrowth on the advances side as well as flat on the deposit side. We've spoken about this time and again over the last 2 weeks because those numbers have been disclosed. That's first on HDFC Bank. Let's pull Kotak Bank up in terms of numbers. You've got a 10% growth on the net interest income. On a year-on-year basis, a 1% degrowth. It's coming below estimates, the net interest income number, and the shrink is largely led by margins. The margins which in Q3 FY24 were at 5.22%, currently at 5.02%. It's a 20 basis point shrink over 2 quarters. So sharp shrink and much sharper when you're looking at it on a sequential basis. 26 basis point shrink when I'm looking at margins sequentially. And that's something that will be key. Going forward as well, how much will margin shrink is really the question. You're looking at operating profit growth 6%. Provisions on a low base have come higher, and profit after tax, including some one-offs, has come in at around 6,250 crore. We'll discuss that and more. Just in terms of growth, before I call on our guests, advances growth 19% year-on-year, deposit growth muted sequentially, a 16% deposit growth year-on-year nonetheless. But with that, let me bring on board both our analysts, Aditya Shah, founder, Hercules Advisors, and Rahul Malani, Deputy Vice President, Fundamental Research at Sharekhan BNP Paribas. Welcome, gentlemen. It's good having both of you here. First, let me come to you, Rahul. First cut, let's first talk HDFC, the larger of the two banks. Your sense of the numbers which HDFC has come up with, margins not recovering, not seeing much. Are you impressed or really unimpressed by these numbers, first off?
So, good evening, first of all. So, overall, this is a decent outcome, and earnings have been slightly better than our expectations in the quarter 1 FY25. And on the NIMS front also, our expectation was a stable of, but marginally they have improved by around 3 basis points. On the core operational front also, it has delivered 2% sequential 2% growth. So overall, a decent outcome during the transition period. Core credit costs continue to remain lower, and bank managed to report around ROA around 1.8%. Although there was, in terms of slightly deterioration in the asset quality due to the seasonality in agri portfolio, but that happens in every first quarter in case of HDFC Bank. So as far as the NIMs is concerned, there will be gradual recuperation in the NIM over the next 12 to 18 months, which the management has already guided because they will be paring down the high-cost borrowings and gradually improving the retail mix would lead to improvement in the NIM that is over 12 to 18 months. So overall, we believe that this is a decent outcome, except deposit growth was weak as was highlighted in the business update.
Okay, Rahul, thank you. Aditya, your first thoughts.
Good afternoon, Harsh. So I feel that the results are okay. There are no added negatives in the result per se, but there are no added triggers for the stock to move up dramatically from here. It's overall a quarter of stability, and I hope that the management gives good commentary about the margins over the next 2 to 4 quarters, that slowly and steadily they'll start to recover. So net, there's nothing to complain about or nothing to boast about in the results personally.
Okay, Rahul, let me come to you with regard to one key point that you spoke about. We've seen NPAs spike up a little bit. Of course, well known, a lot of it will likely be agri. Any cause of concern whatsoever for you?
So basically, I don't see, at least currently in the current cycle, I don't see anything absurd in terms of asset quality, because we have not seen a strong growth in the last if you look at the last 3 to 4 years also. Corporate cycle continues to be benign because growth rate has been muted, and whatever the stress will be managed in case of retail and SME is manageable. And anecdotally, we have seen that retail and SME gives a larger pain in case we have a large economic slowdown. So right now, asset quality is manageable until and unless there is a huge slowdown.
Sure, okay. So take your point. Aditya, let me come to you with regard to margins. Large ship will take some time to turn. Were the margins lower than what you were anticipating? Were you expecting better margin numbers this time around?
No, Harsh, I was not expecting some better margins. If there were 3.5 to 3.6%, then the stock would have shot up in the view that the analysts would have taken the view that the worst is over for HDFC Bank now. We have stability right now at this stage. So as I said, the triggers for the re-rating or the upward rating of the stocks right now don't seem to be there. We have to be really very patient with the company. As the borrowings will start to, as the HDFC's borrowings will start to go down and the retail loan growth will slowly and steadily start to come up, then there will be a recovery in the margin. So as I said, not very disappointed or not very enthused as well.
Rahul, your view with regard to margins, would you agree with what Aditya is saying? Would you also be more patient as an analyst?
So basically, I have already ascribed that margins would improve gradually over the next 12 to 18 months. And this will be led by a gradual repayment in the high-cost borrowings of the HDFC Limited erstwhile. While at the same time, retail mix will also help to support the margins. But margin improvement will not be drastically in the next 1 or 2 quarters. It will be a gradual recovery of 20 to 30 basis points over the next 12 to 18 months.
Understood. And, ROAs continue to be under pressure, Rahul. As an analyst, in terms of building in your assumptions, is that at all a concern for you?
So, as far as return on assets is concerned, we were penciling around 1.7 to 1.8%, and it is in line with our expectations.
Got it. And going forward, Rahul, how will you, does anything change for you just off the bat? I understand management commentary still awaited, but right off the bat, would you change any of your assumptions which you've made going forward?
So basically, I think that currently the consensus are penciling around 13 to 14% growth at least for the next 2 years. I believe that could be toned down because loan growth would be substantially muted over the next at least for the next two years, because until and unless we see normalized CD ratio levels. So basically, I believe that 8 to 9% in our estimates, we have already penciling 8 to 9% earnings growth over the CAGR growth over the next next 2 years. So basically, there could be some tone down in the loan growth expectations going forward by the consensus.
Okay, and do you also expect branch expansion to be less aggressive, Rahul, as part of those numbers that you're trying to extrapolate going forward?
So basically, branch expansion should not be seen from quarter to quarter basis. I believe that there has been it is a conscious decision, and it should be linked from at least you should link it from a 2 years perspective, because it takes a lot of time to invest and all the things to decide upon where the branches have to be opened. So it's a tactical decision. So it should not be linked from quarter to quarter or something.
Got your point. Aditya, is HDFC Bank part of your portfolio, if I can ask?
As a disclosure, we hold HDFC Bank in almost all prime portfolios.
Right. Sure. But is it substantial in terms of an allocation that you make?
Yes, of course. It is a good part of our allocation.
Okay.
This doesn't change anything per se. It's just wait and watch over the next
that's what I was going to come
quarters.
to. Does anything change for you from a portfolio allocation perspective?
Absolutely not. It doesn't change anything per se. It is just a non-event for us per se, because we were expecting slow and steady recovery, and that's what the management is really delivering. Now I will wait further to give any comments after the management tells us what is really happening.
Got a point. And Aditya, how patient would you like to be with the management as well as with the counter? Because it's already tested, I'm guessing, your patience by quite a bit.
Yes. So I think that it will take at least about 12-24 months, but the stock price will move much before the actual improvement comes in. The moment the market sees that the margins are up, moving towards 3.6, 3.7%, the market will try to bid up the stock. That's how the markets really are. There's a lot of liquidity that is chasing the stocks right now. So I'm just waiting for the moment when things start to actually improve, and that is the point when re-rating will really happen.
Got it. Rahul, if I can come back to you, what's the kind of reaction to this result that you're expecting, probably Monday?
So basically, we expect neutral, stock likely to open neutral. We don't expect any negative or any sharp negative or sharp positive reaction.
Got it. Aditya, do you expect any kind of a reaction on Monday? Margin numbers at 3.47, just 3 bips up?
Nothing. No substantial positive or negative reaction in my view.
Okay, understood. All right. So that's, of course, on HDFC. Let's switch focus to Kotak Mahindra Bank, the other big one, which came out with numbers. We did go through the numbers, but Rahul, your first take just with regard to Kotak's numbers.
So basically, here for Kotak, it was a mixed performance by the bank. Although earnings excluding one-off items has been broadly in line with our estimates, but the core operational performance is weaker, led by higher than expected NIMs compression. And core credit costs continue to remain within the guided range, but it was marginally higher as and asset quality trends overall continues to be broadly stable. As far as loan growth and business momentum is concerned, loan growth remained healthy, and in terms of led by pickup in the corporate loan growth, and the growth in unsecured retail advances, particularly the personal loans and credit cards, have slowed down, which is on expected lines mainly due to the RBI sanctions. As far as deposit growth is concerned, if you look at the average growth is decent, but overall end of the period growth is muted, and we were penciling around at least 1 to 2% despite the RBI sanction. We believe that majority of the share of deposits comes from the digital mode. So basically, on that front, there is a slight disappointment of the muted deposit growth. However, on average basis, it's a decent number, and it has been a sectoral phenomena. If you look at the retail term deposit growth, it has been healthy at 4%, but mostly deposit growth is weak, mainly due to the CASA.
Okay.
So overall, we believe that is a mixed quarter.
Got it. Mixed quarter from Rahul. Aditya, your quick first take before we go in and listen to Ashok Vaswani talk about how the bank is evolving in this new embargo era.
So steady results, Harsh. The margin would have compressed obviously, because now they cannot acquire clients physically and they have to spend more on branch banking. So I'm not too worried about the mixed results that they have shown. I want to listen from the management about what they do about this embargo, and when will they go back to RBI to RBI to get this embargo lifted. That is the more important bit that we need to hear from the management, as well as the strategy that the management wants to employ over the next 6, 12, 24 months in order to move the bank forward. As you know, where Kotak is now left, so we need to clearly frame out the strategy that is going to get created.
Okay, excellent. So it's the perfect time to go in and address the media call. Well, MD CEO Ashok Vaswani spoke about the bank's measures when it comes to the tech revamp that's happening there and how the situation has transpired. Let's listen into a slice of that before we go back to our guests and have a conversation.
We have made significant progress during the quarter. In consultation with the RBI, we put together a comprehensive plan to fix all outstanding issues. We have beefed up the internal team with resources from Accenture, Infosys, Oracle, and Cisco, and focused on relentless execution. I feel very comfortable and good as to where we are today. Still more work to be done, but very good progress. We have also appointed GT Bharat as our external auditors with the approval of the RBI, and they have already commenced their work. Needless to say, we are in constant communication with our regulators and keep them updated on all developments. As far as the business is concerned, obviously, it has had a muted impact on growth in our credit card business and in our personal loan business. Our 811 business, while it has a muted impact on new acquisitions, the 811 team has done a fantastic job in deepening relationship with its customers.
Rahul, let me come straight back to you. Let's talk growth. Just in terms of the advances growth, not bad, right? Nearly 4% sequential, despite the RBI embargo. And Mr. Vaswani spoke about how credit cards, etc., have been a drag with regard to growth. The advances growth seems to be surprisingly holding up.
So basically, my view is that the worry is not about the advances growth because they have levers to manage the advances growth. Because if you look at in the last 2 years, the growth has been mainly driven by the retail advances, and the corporate loan growth continues to be muted. So, continue in the coming quarter. In the coming quarter, we would see that corporate growth loan will be strong. But the point main here is if the point should just shift to the LDRs. Right now they have having an LDR of around 87%. So they have little room going forward with otherwise they have to tone down the loan growth because deposit growth has to pick up in order to sustain that 3 to 4% sequential growth.
Correct. Aditya, deposit growth absolutely flat for Kotak, largely in line with what HDFC has also done. Just not picking up, is that a concern? Because clearly Rahul has suggested that could be a concern going forward.
Harsh, that was obviously priced in because of the fact that RBI has given them the embargo. They cannot use 811 and other digital means to get deposits per se, and that is creating a problem for Kotak.
Right.
Anyway, people are investing a lot into the capital markets, as Governor Shaktikanta Das was also saying yesterday, that deposit growth for the entire system is now becoming a challenge. So maybe the banks need to increase the rates per se on deposits to get some deposits back into the system. So, in my opinion, as I said, all of this is linked to the fact that how fast Kotak can improve the technology and move to a model where deposit accretion is faster at a good rate per se. So all of this is linked to that fact, and now we will wait for the commentary to sound what is the way forward.
Got it. Rahul, let me come back to you and let me come back on margins. 5.02%, despite no deposit growth, good advances growth. Do you believe that this leaves Kotak slightly vulnerable when it comes to margins? We did ask Kotak Bank on the media call as to what they believe will happen to margins. They didn't really guide for much. We'll wait for more guidance on that. But what's your sense? Because it seems like margins are under pressure. Despite zero deposit growth, good advances growth, sequential, margins have dipped 26 bips?
So you need to break up the NIM compression, because if you look at the overall 26 basis point, 6 basis point is due to in the last quarter there was an exceptional item of ITR refund. So core net interest margin have declined by 20 basis point, and that is extremely acceptable because the flows at the year end are higher due to in the last days of the year ending. So that impact has come in the full quarter, and basically going forward also at least for the next 2-3 quarters, we believe that outlook on NIMs remains negative, but compression will be at a slower pace, not at the pace which during the quarter at which they have reported.
Got it. Aditya, let me come to you. Do you believe that downside risk on margins will continue to be a concern for Kotak going forward, or do you believe that we've reasonably reached a bottom, maybe 10-15 bips from here?
5.2% margin was unsustainable for Kotak. They were also guided when Uday Kotak was there. He had categorically stated that I believe the margins will settle down closer to 4.8 to 5%. And that's where we are. So we are normalizing an abnormal margin that is there. So nothing too concerning there.
Got it. Let me, in fact, cut straight to the bite. Kotak Mahindra Bank's Group CFO spoke about the factors that have impacted the bank's margins. Let's listen into that. Maybe some indication for things to come. Well, he didn't speak about forward guidance, but listen in.
See, that December quarter NIM was 5.22%. Actually, it increased during the March quarter to 5.28, and for the current quarter, it is 5.02. So the way to perhaps look at it is that it is from December 5.22 to 5.02. It's about 20 bips lower over 2 quarters. The reason I say this is because in March, we had a Sonata transaction towards the year end, which added to a increase in the yield and increase in the NIM, which otherwise ideally should have fallen because, as you know, the deposits challenge continues right from the last 3 quarters. So actually the Q4 NIMs were slightly impacted by some one-off transactions. Obviously, the continuing challenges in the low-cost deposit has put pressure on the cost of fund. So it continues to impact the NIM. As well as, during this quarter, especially, with the RBI IT embargo, there was an impact on the high yield unsecured book. So, for example, we could not do credit card, new issuance. That also impacted the yield on the advances. Plus, we had some liquidity towards the beginning of this quarter, which got deployed at a slightly lower yield assets. All this put together, the NIM actually declined over 20 bips over the last 2 quarters.
Well, lower risk, lower yield assets, likely the largest contributor of that margin decline. Rahul, let me come to you with regard to ROAs. ROAs were nearly 3%. They've, of course, come off sharply from those highs. What do you believe, in your estimates, is the normalized ROA that Kotak can continue to clock sustainably?
We continue to believe that if you exclude the one-off item, the ROA reported on a standalone basis is around 2.4%.
Correct.
So overall, we believe that it will continue to report ROA at over 2.2%, and we believe slight moderation 10 to 20 basis points led by margins over at least in the FY25.
And of course, the fact that you are saying that at least in FY25 means that you're factoring in the RBI embargo. So do you, therefore, if I can just nudge you to opine, do you think that Kotak is managing this RBI embargo well when it comes to its impact on numbers?
So basically, I think so. This was not a full quarter where the embargo was done. So basically, the higher impact would be seen in the coming quarters, because ultimately, what I am earlier also alluded that they will be able to manage their loan growth by diversifying into other segments. But ultimately, they are drawing the deposits from their digital channels. That growth has been will be seriously impacted. So to make the deposits to branch banking is slightly a tall task, and it will take a gradual time. So we believe that deposit growth will continue to be muted, even if for the overall sector, overall at sector level, deposit growth slightly picks, led by increase in the deposit rates.
All right, Rahul, last question. Reaction on Monday, what's your sense?
So basically, we believe that overall outlook, near-term re-rating triggers are not there, and overall, we believe that outlook on the growth as well as NIMs is negative. So basically, we believe that it will likely to trade in negative zone.
Got it. Okay. Rahul, completely out of time. Thank you so much for joining us. Aditya, thank you as well for joining us. It's been a pleasure speaking to you. Thank you for taking out time on a Saturday. With that, completely out of time on this edition of Earnings Edge. Thanks for staying tuned. Stay tuned to NDTV Profit as well. More on the other side.